How you doing?
Good afternoon, everybody. Thanks for attending and thanks for listening. I need to show you that because I may be making some forward-looking statements in this presentation. Artemis. Artemis owns 100% of the world-class Tier 1 Blackwater mine in central British Columbia. Resources of approximately 12 million ounces, reserves of around 8 million ounces presently. And our expansion study, which I'll touch on shortly, shows potential to increase production annually in excess of 500,000 gold equivalent ounces in the first 10 years. So Tier 1, whatever way you define it, large scale, low cost, social credentials, environmental credentials, great jurisdiction, not just in Canada, but also in British Columbia, where we have green power, renewable energy power, and we have very low cost of energy, and significantly large potential for both resource extension of the existing Blackwater deposit as well as the large ground holding that we have. I think the other unique thing that our business model brings to our sector is the extent to which board and management is aligned with all shareholders. Board and management own approximately 38% of our company. That's where our value appreciation comes from alongside yours as shareholders. And that's not been done by some Howe Street, Vancouver trick where we've got magical warrants or other leveraged securities. We've participated alongside institutional and other investors since day one and since the formation of the company. Initial development cost is around 750 million, I should say, but as secured funding of around 820 million. We're a group of people who've done this not just once successfully, but more than once in different parts of the world with large-scale gold mines over the last 20 years. There we are, or most of us, I should say. Jeremy Langford, our President and Chief Operating Officer, unfortunately isn't here at the conference, but he's where perhaps he should be, and that is in the final strokes of construction at Blackwater. But as most of you know, Jeremy has got an excellent background in delivering several gold mines into production on behalf of Endeavour Mining when he was COO of that company. And an array of other people, all of whom have had senior company experience in this industry. Did my microphone go out? Can you hear me? There, I'm back. Good news. This is a slide that we like to present with all due deference to Monsieur Leçon. Internally, we call this the Atlantic curve. And it's a curve that we saw generated when we built the Atlantic Gold Company and developed the Moose River Complex. And it demonstrates share price appreciation during a period starting from the start of construction through to commercial production. And in the case of Atlantic, we achieved a 180% share price appreciation through to commercial production during a period when the GDXJ was actually down 1%, and that was through to about 2018. The Artemis record so far is that we commenced construction at Blackwater, and since then our share price appreciation is about 173%, compared to the GDXJ over the same period to date of around 16%. I guess that is in another way just demonstrating the value that disciplined construction and development of a gold mine can bring significant value, outsized value, to shareholders. For those of you who don't know where we are, we're in central British Columbia. We're not way up in the north. We're like 4.5 hours drive or so from Vancouver, north, not far from the regional capital of Prince George, which is a major center not just for forestry, but also becoming more and more so for mining. We benefit from the renewable energy of the BC hydro grid. We are just completing construction as we speak, and the final conductor stringing of our power line that goes roughly 140 kilometers south from a location close to Vanderhoof. And with those credentials, our social license, our arrangements with our First Nations partners, and some of the environmental initiatives that we've taken, including compliance with the strict regime that exists in Canada and in British Columbia, we think we are best in class in ESG. I'm not going to go through any of these line items, but suffice to say, we at Artemis vigorously defend our track record of checking off key milestones ahead of time, and outlining what they are, and then achieving them on time. And we continue to subscribe to that and vigorously defend that record. The Canadian advantage, apart from our geopolitical risk, of course, we have what I call a turbocharging of the gold price via the FX rate that presides in Canada, and as a result, we've seen a 46% plus increase in gold price since the beginning of 2022, in comparison to other jurisdictions, and that provides a nice safety buffer for all sorts of things, including cost pressures and other factors. At the end of June, we're about 87% complete. We're due next month to give our September quarterly update on construction progress. As I said, at the end of June, we're about 87% complete. We have over 800 employees gainfully employed on site in the various key components of the plant, mine pre-strip, TSF construction, transmission line construction, etc. We've got a moderate climate with year-round access. I guess we're in the 90% complete right now, and we remain on target despite various challenges over the summer for first gold pour in Q4 of 2024. There's a lot of numbers on this slide, but this was the output from a optimization study that we delivered in March of this year, March 2024. And what it focused on is what is the optimal timing of the expansion of the Blackwater mine in Phase 2 and Phase 3. I want to emphasize the gold equivalent grade in the first 5 years of 1.36 grams, the sub-2 strip ratio, and the significant annual free cash flow that will be generated each year at the assumed price in this study of $1,800 an ounce gold and $23 for silver. I also want to outline the production profile as that study portrayed it. We expect gold production to ramp up rather quickly in year 3 to in excess of 500,000 ounces. and a life of mine ASIC of approximately 800 US dollars, and lower in the first 5 years. Frugal with capital. You'll see our capital intensity per ton of throughput in each phase is as competitive as you'll find anywhere. $123 Canadian per ton of throughput capacity in phase 1 with about a $750 million capex. Phase 2, just for clarity, phase 2 is even lower, but that's because it's essentially an expansion of the wet plant. Phase 1 crushing circuit will more or less do the full 15 million ton throughput for phases 1 and 2. And then phase 3 is a full replication of phase 1 and phase 2 to get to around the 25 million tons. But nevertheless, at Canadian dollars, $85 a ton in capital intensity per ton of throughput capacity is very competitive in comparison to anywhere in the world. I've touched on most of these things, but one of the key differences for our project include the low strip, a valley fill design, which generally means that the capital cost is lower, and the risks to capital and the risk to operation are lower, particularly in comparison to a classic sort of paddock-style TSF, where you've got more than 2 or 3 or sometimes 4 sides to a TSF. We've got the one dam that goes across the valley at Valley C, at Dam C. Low diesel consumption because of the topography. Downhill loaded haul from the deposit down to both the plant as well as the TSF and waste dumps. Extraordinary amount of drilling done, inherited by us, by the previous owner. 97% of our reserves have been drilled off to proven status. And as I mentioned, some fairly moderate weather in our part of British Columbia. Other aspects of ESG, including a gender-diverse board. We've got some 45% of our senior management are women. It's a strong initiative of Artemis. The hydro grid, the renewable energy that I've touched on before. We've got a plan to commission with Caterpillar a zero-emission mining fleet by 2029, and all of that output comes with an industry-leading low quartile carbon emission intensity per ounce of refined gold. The exploration upside that I talked about before, this is a slice through the deposit, and as you can see, the designed wall at 1,400 gold shows that the deposit is not closed off to the north and northwest, and conveniently that is the low wall of the deposit. And then we're seeing some more vertical and higher grade mineralization in the area of what we call the southern area of depth in the southern pit wall. So we see the future to put some deeper holes in that area to make this pit and this deposit even bigger than we know it today. In another sense, we have already drilled significant upside in terms of reserves. Our reserves were calculated at 8 million ounces, but that was calculated at 1,400 gold price, which is fairly standard even through to the senior levels for reserve calculation today. But I suspect that with a $2,500 or $2,600 gold price, we'll see people gradually dragging that reserve calculation number up closer to $2,000 an ounce level over the next year or 2 or 3. And just as a side note, if we were to recalculate the resource pit shell inside a 2,000 ounce price, we would add another 3.2 million ounces to our reserve base. We have issued capital of around 225 million shares out, market capitalization today of just under $3 billion. Cash at June 30 was about 111 million. An outstanding list of large shareholders, including board of management. Interestingly, a number of family offices with very significant positions. I think there's scope for some of the more traditional investors, institutional investors, to increase their position, as we transition and continue to de-risk the project through to commissioning and commercial production. We expect some of those large institutional players to continue to increase their position in the company. That brings a close to my formal presentation, Ovais, so happy to take some questions.
Sounds good. Thanks, Stephen. So there's a question right there.
Steve, I was just wondering who's actually constructing the mill and who will be doing the mining. Are you doing that in-house, or have you got outsiders doing that?
A firm by the name of Sedgman out of Australia, which is a subsidiary of the large Australasian conglomerate called CIMIC. In Australia, the mill constructor under an EPC contract, and we will be doing owner mining, and that mining fleet is commissioned and has already commenced the pre-strip.
Any other questions from the audience? Stephen, just one quick one for me. Again, I've been asking the same question regarding M&A. In terms of, we've seen several transactions over the last, I guess, 12 months. We saw Calibre acquiring Marathon. We saw Osisko being acquired by Goldfields. What was the last one? Sabina being acquired by B2. You've got a lot, your project has got a lot of large scale, scope, exploration upside. Do you see any sort of potential bid coming your way soon? And secondly then, or do you prefer, running the project, operating the project and realizing value through that?
Seems that so far we've been left out of the party, but I guess one of the features that Artemis can bring to the table, as I mentioned earlier, Ovais, is that we're in somewhat control of our destiny, owning 38% of the company. So we are somewhat in control of the potential for an M&A transaction, and in some ways it's a positive, because if we were inclined to enter into an M&A transaction, we can probably deliver the control of the company, which I think is a big advantage in an M&A transaction generally. I think every company here who's presented is probably of the view that they're undervalued. We believe we are. Your colleagues in the analyst community certainly say we are. The investment bankers that do drop by every now and then tell us that if one was to apply and flow through the metrics contained in some of the recent M&A transactions for development and de-risked assets, or assets that are now in commercial production, that we've seen in the last 12 months or so, would suggest a significantly higher price than where we're trading today at around the $12 or $13. We don't feel any pressure from our shareholders or us as shareholders to do anything. I think we've still got a lot of work to do. I think we've got some potential that we want to demonstrate. It's still, everyone's talking about here at this conference the disconnect between the commodity price appreciation and the equity price reflecting that. We're no orphan in that respect. We're not probably reflecting fair value, and we're lagging behind the commodity price, notwithstanding a pretty good performance regardless. So that's a long way of saying I don't think we're ready for an M&A transaction. We want to, in this show me market, show you, the investor market and the capital market, what this asset potentially can do, at least in phase one, and get phase two underway, and where we have what we need to do that. But at the end of the day, our job is, as management and as a board is to maximize shareholder value, whichever means that is achieved, whether it be in the market or whether it be by an industry M&A transaction.
Excellent. Thanks, Stephen. Appreciate it.
Thank you.